Norma issued, now listen to the question well. All the things we've been doing so far, it has been bought. But say CRT language, issued. So Norma issued 20,000 redeemable debentures at their $100 par value, incurring issue cost of $100,000. The debentures are redeemable at a 5% premium in 4 years' time and carry a coupon rate of 2% and effective rate on the bond is 4.58%. Required. Calculate the amounts to be shown in the statement of financial position and statement of profit or loss for each of the 4 years of the debenture. A-B. For each of the 4 years of the debenture. So what do we do? How should Norma classify this financial instrument? They are the ones issuing. Should they classify it as an equity or as a liability?
They are issuing it.
Yes. Liability. Why?
No. Wait.
I'm waiting. I have patience a lot. I'm waiting for you.
If it's repayable, then it's a liability.
Good.
But
they are supposed to redeem, right?
Yeah.
So it's a financial liability. So Norma classifies the financial instrument as what? A financial liability. And how did we say we account for it? At fair value, less in what? The issue cost, isn't it? So what was the proceeds from the issue of shares? Issue of the debenture, sorry. It is 20,000 times 100. 2 million. We tell the examiner that we want to be lazy here, so we will use 1,000. So 1,009. Hey, 2,000. Now, this is the proceeds. So the initial cost will be what? The proceeds minus the issue cost. Does it make sense? Minus the issue cost or the transaction cost. What is the issue cost?
Issue cost is 100,000.
100. Until now, the initial cost is going to be what? 1,900. CNE, very low. Now the examiner said we should calculate the interest payable and as well as what? Amounts that will be recognized in the financial position for each year. So we have to do our schedule here. So let's go. Balance brought forward, interest, payment, and balance carried forward. Now, what do we do for the payment? Where do we use the coupon rate? Where do we use the effective rate?
The effective rate will be the interest.
Okay, so what is the effective rate?
4.58.
4.58. And then the coupon rate is 2%. We go. So in year one, the amortized, so this is the amortized cost schedule. So the amortized cost, which is the initial cost, is 1,009. Do the percentage for me quickly. Eight to the nearest hundreds or thousands. Okay. So 87. Then 2%. This one will always be done on what? The proceeds. Okay? The proceeds. So 2% of the proceeds. 40. Now, this is going to be the same for the 4 years. Okay? It's going to be the same. So, give me the current value at the end of year 1. 1947. That becomes the opening for year 2. So, interest on that. 89. Carry forward. 1996. Year 3. 1996. 91. Carry forward. 2047. In the year 4, 2047, get an interest on that.
94.
So 94. But be careful here. In the 4th year, in the 4th year, there is not going to be any carry forward. But what payments are going to be made? They are going to be redeeming it at what? A premium of how much? 5% in TNA. Omo beti omo interest 40 no. Na omo se aje sika na yede omo de maye no. And the premium. So the premium is 5%, right? So 5% of the 2,000 is what? 5% of the 2,000. $100. So listen, they will take the premium plus what? The nominal value, 2,100. Please, do you understand? In the 4th year, no, interest. Normal J, nominal value no plus the interest no. Into your arithmetic no, it should give you 0. It won't. It won't. Then go, baby. Yes, it's because of approximation. $1. It's because of approximation. So that one is allowable. So this is how you solve the question. Are we done? No, because this is not what the examiner said we should do. What did they say we should do? The financial statement. So what did they say you should prepare for? Statement of what? Profit or loss. So statement of profit or loss for the 4 years. So year 1, year 2, year 3, year 4. Now what comes in the statement of profit or loss? The interest. So we go 87, 89, 91, and then 94. Then we come to the statement of financial position. Year 1, year 2, year 3, year 4. Thousands up. These carry forwards. It means year 4 nothing will be there, but Michelle middle 2. So control will be over. So financial liability. Because that's at the end of the 4th year, there is nothing. So 1947, 1996, 2047. Year 4, so nothing will be there. So this is the answer to the question, and that's a financial viability. So I want you to get a difference. Issue costs and proceeds, no, and yet they be deducted. If it is a financial asset held for maturity, or held for long-term strategy, or held through profit on OCI, then we don't deduct the financial instrument. We don't deduct the issue cost, but rather what do? We write it off. Are you getting it? But
OCI.
Yes, when it is OCI, like the question we solved. You realize that the proceeds were not deducted. We take it to, we added the proceeds rather, okay? We added the proceeds. But if it is through profit or loss, then we what? Write it off. Then if it is also a loan note, and we are the ones issuing, the issue cost is what? Deducted. The issue cost is deducted. Meaning, you don't take it to the P&L. You deduct it. So the double entry of this, if I want to do double entry, is like this. Proceeds Nankasano, I'll debit cash, 2,000. Then I'll credit what? Financial liability, FL, 2,000. So this is what? The proceeds. Then the issue cost. I will credit my cash book because I paid the 100 out. And then debit what? The FL, financial liability, 2,000. It's almost an income statement B and I. That's the meaning of this thing we did here. This is the meaning. Then I now do my schedule. So what comes in the income statement? Yep.
You debited them for 2,000.
Hey, hurry. This is the issue cost. That's what makes financial instruments one of the best standards. It's the principles. So if you don't get it well, suppose say you can't now hear the opposite. Now, as always, the financial liability here could be separated into its current and the non-current components. How do we do the separation? The annual payment receivable could be treated as what? Non-current liability. Okay? Then the balance left will be, the annual payment receivable could be treated as current liability, and then the difference will be treated as what? The non-current liability. So we could segregate these into current and non-current. Madam. Statement.
The venture way, no. So they are redeemed now at a premium in 4 years time.
Yeah.
So it was in the 4th year that
we brought the premium plus the nominal value, which was the proceeds.
When you go to the financial assets, and I two different things.
There is a financial asset question here, and near the whole schedule. Sankai.
Because I don't know.
Sankai, the whole schedule like the same effect to be.
Okay.
But I don't know, you near the whole schedule.
Like I'm so 4th year, they use 5% premium. No?
Premium, no. Now you use nominal value, no, which was 1,000 or 1 million.
Okay.
Now whatever money they are supposed to receive, so no,
Okay.
So it's the same treatment. Okay. The same treatment. Now, so let's move on.